Hello, investors. Welcome to this webinar. So glad that you're joining me today. I'm going to be talking about one of our latest funds, the Aspen Private Credit Fund. This is an opportunistic, income-focused fund that we believe is really poised to perform well in this current economic environment. So glad that you're joining me for this webinar. I'm going to talk about the fund, talk about our strategy, talk about our team, and who we are and why this is such a great fund and how it fits our skill sets as a team at Aspen Funds, why there's an opportunity in the market, and why is this such a great risk-adjusted return opportunity for investors. And then I'm actually talk about specific assets. So this fund we launched earlier this year in Q2. It's already off to a great start. We've had a lot of capital that's already funded, a lot of capital that's been committed, and we've already closed on 6 assets. So you get to see behind the scenes, under the hood of exactly the type of assets that we're going after. And then I'm going to walk through at the very end some frequently asked questions that we get from investors as they're considering this fund. So with that, let's dive right in. Before I do all the things I just mentioned, got to give the disclaimer here. This is not an offer of securities. This is purely informational. If you are interested in learning more about this fund, you must review our private placement memorandum and review all the risk factors within. I will be talking about projected returns. Those are forward-looking statements. They're not guarantees. Any past performance or track record that I show is not necessarily indicative of future performance. So got to give all the caveats first, but here we go. So if you're newer to our firm and our team, I want to just give a real quick background so you know who we are, some of the faces behind the name Aspen Funds. Our 2 co-founders are Bob Frazier, Jim Mafuccio. They started Aspen over 11 years ago. Both come from very unique backgrounds in investing in real estate and really saw an opportunity coming out of the great financial crisis in distressed debt, buying distressed residential mortgages. And at that point, what the market was doing and the timing to get in, it just made a lot of sense. And obviously, it was a great time to get into that type of asset at that point in the market. And has really launched Aspen Funds, 10 years later, into multiple asset classes. We have assets all over the country, a lot of different verticals. And what's really formed our thesis and our theme of how we go and look at investment opportunities for investors is understanding the big picture, understanding the macro environment, what is creating opportunities in this current marketplace, and then creating structures, strategies that are investor friendly, that are putting investors in the right places in this market. Because as we all know, timing really matters. Where you invest and what you invest in really matters at different points of the cycle. And that's why we're so excited about this particular fund in this environment that I'll get into here in a little bit. The 2 other partners that we have at Aspen, we have Dan Schulte and then myself. Dan Schulte, he's our COO and managing director, has a great background in private equity, actually in publicly traded markets, as well as an attorney and a CPA. My background is I'm the CIO. I'm a commercial banker, a reformed banker, and also do a lot of our capital markets, deal structuring, asset management, and underwriting for Aspen Funds. Okay, as I mentioned, our process for identifying deals is a little bit different than maybe a lot of operators that you've seen out there. And what makes us different is that we're very macro aware. Our tagline, if you see our website, is macro-driven alternative investments. What we want to do is look first at the big picture. Are we investing in the right asset classes at the right time, right? Because you can invest in a good asset, but if it's in a bad market or a bad time of the economic cycle, it doesn't matter how good the asset is, it's going to underperform, right? Conversely, if you're investing in a rising tide, right? A rising tide lifts all boats, and we want to invest in the rising tides, and that's why this is so important. And so with that, we then look at the best asset classes, the best strategies that will benefit from those trends. We put together the best teams, investor-friendly structures to execute on those strategies. One thing we like to highlight on every every deal is we invest alongside of our investors as LPs. We co-invest for true alignment of interest and to put our own capital to work alongside our investors. A little bit of our track record, like I said, we've been around for over 11 years. We've been operating in multiple asset classes. We've raised over 200 million. We're actually approaching 250 million in capital raised from investors. Over 500 million in assets. 11-year track record, and one of my favorite numbers is over $50 million distributed back to investors since inception. It's actually closer to 65 to 70 million now. I love seeing that number tick up. It's always fun to raise money, but way more fun to send money back to investors when a project's performing well. A little bit of our experience. Like I said, we invest in a lot of different asset classes. We have a very deep experience in a big portfolio in debt, mortgage notes, multifamily, storage, industrial, retail, as well as some oil and gas. If you've been following us at all for any length of time, you've probably seen or heard us talk about our podcast, Invest Like a Billionaire. Always going to get a little plug for this if you haven't listened to it yet. We really strive to educate investors to become better investors and to learn what the ultra wealthy are doing so that they can level up their investing game. And so this is a big passion project of ours to continue to bring education to the marketplace for investors to learn how to be better investors. Okay, let's dive right in. So like I said, this is the Aspen Private Credit Fund. It's an open-ended fund. And what we're doing is we're providing credit to commercial real estate properties. So a dislocation in the capital markets has created a really unique opportunity for non-bank lenders and investors like our fund to provide capital through either preferred equity, mezzanine debt, and bridge loans. We're investing exclusively in real estate. Some credit funds will invest in businesses. This is totally different and arguably much safer because you're investing in an asset, not just a going concern of a business. And this fund is focusing on really two things. Primarily, current cash yield. We want to generate cash flow from the investments, and we want upside through profit share. So we want to participate in the performance of a project. So we're doing that, and then we're doing that in a preferred position in the underlying investment. I'll break all this down here in a little bit, but those are the three things we look for. Cash flow, upside, and investing in a preferred position where we have priority over equity investors in repayment, also have control rights many times to take over a project that's not performing well. So some of the key reasons to invest, like I said, high current yield. It's our focus is on generating high yield to investors on a monthly basis, or you can choose to compound. We invest in a preferred position in the capital stack. So the underlying assets, we have a priority of payment over their common equity, and we many times have takeover rights for events of default. I mean, we can take over a project if it's not performing well. The structure is really unique. It's an open-ended fund, and I'll talk about that more in a minute and what that looks like, but we think it's a really, really great structure for this type of an asset, and I'll talk about that in a little bit, but there's a great benefit for investors because of liquidity. We have a 2-year lockup, and you have liquidity with about a 90-day notice period on a best efforts basis. Some other reasons, strong sponsor team. We've been operating debt and credit-focused opportunities and funds for over 11 years. This is a core competency of our teams. We've also been operating open-ended credit funds from really inception. So we're leveraging our experience, our staff to perform in this. We're investing in all of our deals alongside of our investors. And the cool thing with a fund focus versus a single asset syndication is you're going to get diversification into all the assets that are in the fund. And so, like I said, we already have 6 assets that we've closed on in just the past few months. This fund will continue to grow, and we'll continue to make investments in assets across multiple geographies, multiple asset types, multiple strategies. So you're going to get a lot of built-in diversification with this fund. Okay, let's talk about the fund overview. So this is some of the nuts and bolts, right? And I want to talk about this early on because I want you to understand some of the way that it's structured, some of the benefits, and how we've built this fund to we think be a really a great structure for investors and a great long-term fund that can grow to be a very large fund over time. First off, we're making regular distributions. So after an initial 3-month what we call deployment delay that allows us to go and deploy your capital into producing cash flow producing assets. You start getting monthly preferred return distributions. Those are targeted, they're not guaranteed. And then quarterly, we pay out an additional profit share based on the quarter's performance. And so you get monthly payments, and at the end of the quarter, you get a larger payment that's for all the additional profit that was generated from the investments made during that quarter. We also have the ability for you to automatically reinvest. A lot of our investors are choosing to reinvest, kind of an automatic dividend reinvestment program that you can use to compound your returns. So you can invest those earnings back into buying more shares of the fund, and that will allow you to compound and grow your capital balance, account balance faster. It's an open-ended fund, which allows us to do that reinvestment to where you can continue to buy more shares and grow your account balance over time. You can add more capital to your account over time. We do quarterly NAV calculations, net asset value calculations to create the net asset value of the fund that you're purchasing more shares at. We're investing in preferred equity and mezzanine loans, commercial real estate. And again, the focus of our fund is during current cash plus profits in a preferred position. This is a non-dilutive fund, meaning that cash coming in is not diluting NAV per share. We're not reducing the value of the assets in the fund with the cash. The cash is being brought in to purchase new assets and to be deployed into producing assets. We have a high watermark, so the NAV price, the unit price per share, must exceed the highest last 12-month price for us to generate to take our profit share as the manager, right? So we're prioritizing investors both at a preferred return, but also if we're not meeting expectations of the fund by increasing the net asset value of the fund per share over time, we don't get paid our profit share. We send out monthly distributions, profit share quarterly. We also send account statements and fund reporting on a quarterly basis so you can get consistent communications to know exactly where your account is at and what is going on in the fund over the quarter. Liquidity. So a lot of funds don't have this provision. This is a pretty unique aspect of this fund is liquidity. We actually can allow investors to request a full or partial redemption of their capital account after a 2-year initial lockup period. We request 90 days notice. If you have a large position, we request a longer time frame to be able to have flexibility to do that. In our other open-ended funds, we've done a really good job of being able to meet these requests from investors. Again, it's not guaranteed. It's best efforts, meaning we do our best to meet those requests in the time that they're requested. And to date, we've done a really good job of that. Haven't never really missed redemption requests from an investor in other funds. And so that is a benefit of this fund. Some of the structure or minimum investments, $100,000. It has to be accredited investors. We are from the get-go. This year in 2024, we're getting a CPA audit. We are having a CPA firm audit our financials, so you have confidence in the financials that are being reported and the net asset value that is being generated. We expect to be able to generate the returns with very low leverage. Right now, there is no leverage in the fund. We also recommend or welcome IRA investments. So you can invest through a self-directed IRA into the fund. And again, results are not guaranteed. Okay, here's a little quick overview of our share classes. We have 3 different share classes, and they're all based on the amount of capital you're investing into the fund. So the bigger your investment is, the better returns that you can generate. But most investors will invest at the Class A shares. We have several investors at the Class B, a few at Class C. And you can see the preferred return on the Class A shares is 6%. And then everything above that, investors get 70% of the profits above the 6%. And so the total net return, if you're receiving your distributions in cash, is expected to be between 10 and 12% on an annualized basis. And that includes both the cash flow plus the profit share and the net asset value increases to your share price. We expect the actual cash being distributed, which does not include the net asset value increase of your account, to be between 8 and 11% paid out a monthly basis, and that's an annualized number. If you choose to compound your return, so if you take all your earnings and you reinvest it back into the fund to purchase more shares, you can expect between 11 and 14% annualized return. And again, the AUM fee, asset management fee, is 2% on this share class. Okay, let's talk a little bit about big picture. I'm going to kind of run through this because we have a whole master class on private credit. Why is this so interesting right now? And I encourage you to, at the end of this presentation, I'm going to have a QR code that will take you to our data room. You can review all this information more in depth, and we have a whole link to a masterclass that we spent a lot of time going through a lot of the big picture things going on. So I'm going to run through this pretty quickly, but it is important to set the stage for why this is such a great opportunity right now. Well, the big picture here, and the reason that a lot of these opportunities are being created is tighter credit creates gaps in the market. So credit is basically availability of debt, right, or debt-like investment from either banks and other lenders. And it's been a huge pullback on leverage ratios from banks, new deals due to negative cautious sentiment. A lot of banks have been worried, right, about what's going to happen to the economy. And an even bigger issue many times is the lack of payoffs. They actually don't have the ability to lend out capital, even if they wanted to, because the current deals they have on their balance sheet are not being paid off because interest rates have been higher, and some of those deals are struggling. They can't go get a refinance to clear off their debt, off their balance sheet, and so they're staying on longer. So this is creating a slower pipeline for banks to be able to fulfill new investment requests into new deals. And further, a lot of banks are being constricted due to additional regulation. So there's a new set of rules called the Basel III Accord that's going to be adding increased stress to the financial system. It's going to increase capital requirements. It's going to change business models, going to increase liquidity requirements and compliance costs. It's going to really impact small banks. So we expect there to be even more consolidation in the banking space over the next several years. This creates a smaller pool of available traditional banks. And again, their appetite has largely been pulled back. And we think it's a structural issue. This is not just a temporary issue. This is a structural thing that is going on in the market that is requiring new capital sources to come into the market. Meanwhile, there's still some great long-term fundamentals, and this is for the housing market, which we're still very bullish on as the primary focus of this fund. There's been a long-term underinvestment, chronic underinvestment in housing, new assets that are being delivered to meet population growth and household formation. There's a shrinking single-family buyer pool. There's not enough product available. Renting is cheaper to own right now, and so it's pushing a lot of people to rent into multifamily. But meanwhile, household formation is strong, so people are wanting to move out of parents or with friends, and they want to go and have their own place. And there has been some challenges in the multifamily or housing sectors in some of the southern markets, but they're really the high supply markets. But in the Midwest here, where I'm at in Kansas City, Rust Belt in the Northeast, this is from CBRE. They're actually expecting 6% rent growth in these markets, right? So it's a very different, depending where you're at geographically, it's a very different story. The bottom quartile markets are seeing some rent declines, but that's really due to high supply. There's been a lot of supply that's been delivered, but it's been delivered in a very concentrated set of areas that is currently putting pressure on absorption. But again, it really depends where you invest because every market's different, and there's actually a lot of tailwinds in some of these Midwest markets in Rust Belt and Northeast. So our strategy, what are we doing? We're investing through a combination of what I said, preferred equity, mezzanine debt, and bridge loans. And we're generally investing kind of the middle section of the capital stack here. So the capital stack is the priority of repayment on an asset. So the senior lender, always gets paid first. And then in most deals, you have some form of equity, but a lot of times you also have preferred equity or mezzanine debt. It's becoming a lot more common. It's been around for a long time, but it's becoming even more common. And when we're investing in one of these two areas, what we're doing is having priority of repayment before the common equity. So what that does is it lowers our risk, reduces risk of capital loss, because our last dollar in is has to get paid before a dollar of the equity investors get paid. So it reduces our risk in the investments that we're making. And then we can also prioritize ourselves in the waterfall of cash flow. So we're generally going to be receiving most or all of the cash flow coming out of the project to pay our current pay portion of our investment. And in a worst case scenario, if a deal is not performing, if operators not meeting the expectations and it's in default of their agreement with us, we many times have takeover rights that will allow us to either take over the deal and operate it, or force a sale if they are not hitting those expectations. Private credit, it's poised to be an outperforming asset class. This is from BlackRock, and they're showing kind of expected risk-adjusted returns over the next 5 years. Lending, direct lending, non-bank lending is expected to be the top performer from a risk-adjusted return standpoint. How do we source deals? We're getting it from brokers, placement agents that are looking to help sponsors find capital sources. We're getting it direct from lenders that have deals that some of their deals are in a position where they can't get refinanced yet, and maybe they need some cash in to pay down the loan, to buy an interest rate cap. They need a capital infusion to finish renovations. There's a lot of lenders that can reach out to us to help good deals, but they just need a little extra capital. And then also our own network. We have a pretty big network of sponsors that we've developed. Most of our deals are coming through our own network of sponsors as of now. So some of the types of deals that we'll do, and I'll give you actual examples of the 6 deals we've closed here in just a minute, but most of what we've done and we expect to do are new deals, new acquisitions. This is not a distressed lending fund. I want to be really clear about that, because there are some out there that are going in to basically rescue distressed deals. That's not the focus of this fund. Most of what we do is for new acquisitions that are at a good basis, that have a good business plan from starting point now versus a couple of years ago, and they're struggling to get through. Now, there are some situations that can make sense. Most of what we do is new deals. Some of the things that we can do, we can help do a quick close and gap funding, right? Either the senior lender falls through, or they can't raise enough equity in time. And the goal here is to bridge gap from a short-term standpoint, a closing. Loan assumptions. There's a lot of times, a very, very popular strategy right now is buying a property and assuming a low interest rate loan from usually an agency lender, say Fannie Mae or Freddie Mac. Well, it's great from an interest rate standpoint on the senior, but usually they're very low leverage. And so we can actually come in behind Fannie and Freddie on a loan assumption, increase the overall leverage. It increases the return for their equity investors, and we're coming in at a really good position in the capital stack. New construction. So banks are reticent to lend, generally very low LTVs. The goal is to increase overall leverage and provide a little more capital to finish out the total capitalization. Some of the existing deals that we can do, right? It's going to be very limited, but they are in a good position, but they need a little more capital to kind of get it through to stabilization, and then it can refinance. Usually it's going to be, something along the lines of their interest rate cap is expiring. They need to purchase another fixed interest rate cap. They need to bolster their reserves. Their lenders requiring them to have more cash on hand. They need to finish a renovation program that they haven't completed. So again, the goal here is to protect the equity, and usually a lot of times these situations, they are really, really close, but they need to kind of just get past that, final stage to stabilize and wait for the next round of either refinance or sell the property. Sometimes a capital injection is needed. So in another situation, maybe they have low interest senior debt in place, and they don't want to refinance, but they still need additional capital to do one of the other things I just mentioned above there. Okay, let's talk about some of the actual deals that are in the fund right now. So again, if you invest in this fund, your capital is getting spread across all 6 of these deals. as well as any new deals that we purchase into the fund as it continues to grow. So this is one of the loan assumptions that I just mentioned. Essentially, the sponsor, they're assuming an agency loan with under a 3% interest rate, but the LTV is very low. It's a 45% loan to value. So layering in some preferred equity, it helps increase their investors' returns. And it also allows us to be in a really secure position in the capital stack. So where our combined loan to value in this deal is 60%. So we have a 40% equity cushion above our investment. And we also can force the manager to sell the property if they're not paying our 8% current annual interest rate. So usually in these types of deals in a preferred equity investment, you have some upfront fees and you have a current pay portion to where they have to pay that every month. And then you have a back end portion that's an accrued amount that gets paid when the deal is refinanced or sold, and it gets added to their capital account balance. And we have usually an exit fee as well. So you can see here on this deal, we have a 2% origination fee, 8% with current pay. That's what they have to pay us on a monthly basis, 6% that is accrued and added to their capital account balance and paid once the deal sells or refinances. And then we also have another 1% fee when this deal is sold. Our term is 3 years. We expect to be out of this deal within 3 years and be taken out to refinance once they finish their renovation program. This is in our backyard. It's literally a few miles from where I live. This is a great submarket. Know right where this is, and it's a great deal with a great sponsor. Here's a picture of the asset. The sponsor team is vertically integrated. One of the great things is the current NOI, even before they've completed their value add business plan, supports both the senior debt and our current pay portion. It's a light value add business plan. Not a lot of CapEx needed, a very kind of simple unit renovation plan. They're already achieving those rents. A lot of margin for takeout financing in 3 years. Okay, here's the second deal that we've done. We've acquired a Class A industrial building in Waycross, Georgia. This is a little outside of Atlanta. It's a great asset, a great basis. This is a sponsor that has been doing this for a long time. They're really a semi-institutional quality sponsor. Incredible track records. This is pretty much all they do. Big capital behind them. This is a former tenant-owned building. The tenant is moving locations. They owned the building. They're now selling it. And so we're buying this at a $52 per square foot basis. That's about 30% below replacement cost. So an incredible basis. Layering in some preferred equity, again, helped increase the IRR. We sourced this deal through a well-known relationship, one of our brokers that we've done deals with. We're at a 75% LTV and, again, 25% equity cushion above our investment. So before any of their equity investors get paid, we have to get fully paid off all of our fees, all of our current pay. On this deal, we have a 2% origination fee, 5% current pay, 10.5% accrued compounded annually, and a 2% exit fee. We have a 2-year term on this. We expect that we'll be taken out through a sale of property once they get it leased up. Again, institutional level sponsorship group with deep industrial experience. It's a strategic location in the southeast for distribution, a pretty conservative business plan. We really like this asset. We expect it to be paid off within 2 years. Multifamily takeover. So this is a pretty unique story. We're seeing this more and more. So the prior owner of this asset was forced to sell due to underperformance. They were actually in pre-foreclosure with their lender, who's a private equity lender or private debt lender. The lender reached out to our sponsor, our operator, and said, "Hey, we've worked with you. We know you guys have a really good track record. We want you to take over this asset, and we're actually going to take a hit, a discount to what we're actually owed on this asset if you'll come in and purchase it." So the sponsor came in, they purchased it. The current lender took a slight haircut on what they were owed, and they actually came in with a new fund and lent them their debt on the new acquisition. And again, the sponsor got like an immediate 25% discount on price, right, from what the last donor purchased it at. And they literally have a lot of other assets in this area. There's a property that's literally adjacent to it that is 100% leased at higher rents than our pro forma. It's the carbon copy of this asset. We're at a 70% loan to value, 30% equity cushion above our investment, and we have takeover rights along with some great overall yield in this deal. Again, the sponsor's in Atlanta. Atlanta's a great market called St. James Place. It's located at the airport with a lot of large employers. This sponsor has over 20 full cycle exits, very impressive track record. And it's a shorter term business plan, which we love. Fits our mandate to have shorter churn of capital. Okay, here's our fourth multifamily. I'm going to kind of run through the rest of these a little bit quicker here, and then we're a little short on time. This is a very experienced developer in Northwest Arkansas, which is a market we love here in the Midwest. It's on fire. It's one of the fastest growing cities in America. Bentonville, it's where the headquarters of Walmart is. They're actually building a multi-billion-dollar new headquarters and bringing a ton of employees back to Arkansas. The developer, they have over $9 million of common equity in this deal, with significant deposits required by the bank. We have a $3.3 million investment into this as a preferred equity investor. We have takeover rights and we have for sale rights. We're at a 66% loan to cost, very, very low on loan to value. Once it's stabilized, we have really great terms that we've negotiated. We also negotiated a participation in the upside with an equity kicker to where we actually participate in the performance of the asset once it's sold. We expect this to be a great performing asset in the fund. Performer rents are based on current market rents, though the market continues to have strong rent growth. Be delivered in a very tight supply market, right next to Walmart headquarters. Exit valuation is $233 per door. There's already sales comps, even at current market valuations that are at that price. So very conservative. A 2-year construction time frame, 1-year lease up. Okay, this one is a neighborhood retail strip center. If you follow us for all, you know we love this asset class. We were very bullish on neighborhood retail for a lot of reasons. The biggest being supply and demand. There's not really any new supply of neighborhood retail strip centers being built. Meanwhile, retail has actually been very strong, very, very resilient, as a lot of these strip centers house non-Amazonable businesses. What I mean by that is businesses that are service-based, right? They're dog groomers, they're liquor stores, they're a place where you get your nails done, where you have restaurants to go eat at. These are things that can't be replaced through e-commerce. And so there's a lot of demand for this. We're seeing, literally strong rent growth in retail. This is in Derby, Kansas, Wichita, which is a market we have a lot of assets in that we like. This is a great submarket of the area. We've worked with a sponsor before. We know them very well. We actually have a secured lien, second lien behind a senior loan. We have a very strong equity cushion above our investment. And because we have a secure lien, we can force foreclosure if they're not paying. So we have great terms, plus we have a security with the asset. You can see here, these are month-to-month tenants, so it's really a value-add business plan, improve just the curb appeal, get some new tenants in place, and get them on triple net leases for longer time frames to increase the overall value of the project. The great thing is, these are very high cash flow properties generally, and so we can cover a lot of the debt service and our current pay through the cash flow of the property. Okay, last one. So this is another investment I'm really excited about. So the last one we just closed on a few weeks ago. Very experienced sponsor located outside of Tulsa. The sponsorship group has been in real estate over 50 years combined, pretty much either as a broker or an operator for most of that time. They're very focused on workforce housing with newer vintages. There's a very tight supply. So they're in Pryor, Oklahoma, and Arkansas City. This is a 2-pack property, one each of these markets. Both are big manufacturing hubs, which is another big thesis that we're very bullish on. And it's a really, really incredible basis. They're purchasing these for about $70,000 a unit with an 8% yield on cost. So for multifamily, that's pretty insane numbers. Really, really strong basis, really strong cash flow. We're coming in and basically filling the equity gap for these guys and bring a $2 million investment. We have both takeover rights and forced sale rights. We are coming in at 79% loan to cost, even a much lower LTV once they're stabilized. The great thing with this is the cash flow can support our current pay day one, right? So we got cash flow coming in from the property. These are nice properties in very tight supply markets. It's a proven business plan. They've done it before. Like I said, the sponsor is it's an incredible track record. Very impressive. Working with a large property manager group that's has executed this type of business plan many, many times. All right. We have a very strong deal pipeline. We have over $20 million of deals at different stages of our pipeline. Most are closing in the next few quarters. You can see lots of different types of deals, different amounts, preferred equity, second lien, mezz. Again, just a lot of opportunity right now. And just a great time to be jumping into the space if you haven't already. A little bit of just the portfolio statistics, right? So this fund's been operating for a few months now. It's been extremely efficient from a capital deployment standpoint. We've already deployed $11 million into these assets, and we have funded from investors $11.14 million. So a 99% deployment efficiency. So we've been very, very efficient with timing and doing capital calls and bringing in capital to close deals. We already have $12 million of new capital committed over the next quarter or so coming into the fund. We expect this to continue to grow pretty rapidly. On the risk return dynamics, we have 6 fund investments. As walked through all those, our average loan to value is under 70%. Average loan to cost is just over 70%. Our weighted average maturity is just over 2 years. And our gross yield to maturity, so this is the gross yield that we're generating on the fund is almost 18%, which is quite a bit higher than we actually originally underwrote in our pro forma. No deals are in delinquent status. A little on our track record. Here's really what we focus on. We're kind of targeting over time the fund to balance out into these 3 different buckets, the largest being preferred equity. But we expect this to change over time. There's a lot of opportunities we see on the bridge loan side, on the mezz debt side. One of the cool things that we have with our fund is we have a lot of flexibility, right? Because it's a fund, we can continue to raise capital. We can continue to add assets to it. And we can write checks in the size of $1 to $5 million per project. A lot of players won't go even below 10 million because the inefficiencies from the scale of their capital, they have to do single raises for every one of their deals, or they're just so big they can't do anything smaller than that. So it allows us to go and make placements into deals. There's not a lot of competition, which is why we're generating such high yields in preferred positions in our capital stack. And we diversify across a much broader set of properties and geographies, right? Because we can invest smaller amounts in a larger set of properties. So we think there's a real great kind of triple win there from the sponsor groups that need the capital, that don't have a lot of options. We can, have kind of a corner of the market, generate higher yields, and the fund then gets more diversified and spread across more assets as we grow. I'm going to kind of skip some of this. You can review all of our track record in our data room, but we've been operating credit funds for over 11 years. We've deployed a lot of capital, have done a lot in this space. You can see here a lot of real estate assets as well that we own and operate. So one of the great things with us, we're not just a lender, we're also an operator. So we can go, if we have to take over an asset, we know what to do. We operate assets ourselves, and so we can come in and step into that project if we need to. Strong support team. CBIZ is going to complete our audit. Polsinelli advises us on matters of the law, and we have another law firm here that helps us assist in due diligence, negotiations, legal review of all the deals, etc. All right. If you are interested, you want to talk with someone on our team to learn more about this fund, see the opportunities we have to come into the fund. We do kind of limit the amount of capital that we'll allow every quarter in, so we can keep that efficiency really high. Like I said, we have a big full commitment list of investors. So be sure to reach out to our team so you can have a spot reserved for you to jump in the fund. I'm going to run through some FAQs real quick, and then we'll wrap this up. And appreciate you guys staying up to the very end here. So how long has Aspen been managing funds? I've answered that. It's been over 11 years in credit, in open-ended funds. This is our bailiwick, our wheelhouse here. What makes us different? We're looking at the big picture, right? We're finding deals that are going to perform in a rising tide. And we really think this is a really great place to be as an investor, is to place capital in these types of deals. Initial lockup period of this fund is 2 years. So like I mentioned earlier, we have a 2-year lockup with a 90-day liquidity notice on a best ever basis to get your funds back. This fund is open-ended, so we're coming up with a new net asset value every quarter that you can buy shares at if you're automatically reinvesting, or you can get redeemed at your current position if you'd like, or invest more at that current value. You'll start seeing distributions very, very quickly. So we have that initial 3-month delay, then you'll start seeing distributions right after that. On a monthly basis, we send out the preferred return. On a quarterly basis, you get that quarterly profit bump to get your overall yield into those low double digits like I was talking about. You can absolutely invest with an IRA through a self-directed IRA custodian. We have a lot of investors that have done that. This is a great fund for an IRA type investment. Just so you can defer some of those taxable gains and taxable income. The types of assets we're investing in, we've already walked through all 6 of those assets before. We're going to continue to do more of the same. We expect that we'll have more secured types of investments and properties over time. We expect to generate a single K1 for our investors. It's possible we may have a K1 or 2 in different states if the state requires that. But for the most part, all you'll receive is a single K1 from your investment in the fund. And then next steps to get started, like I said, you can take a picture of this QR code. You can reach out to our team at investorrelations@aspenfunds.us, or you can text the word credit to 913-214-1474. And that will get straight to our team, and we'll schedule a call with you to answer any of your other questions and get you signed up if this seems to be the right investment for you. All right. Thanks so much for watching today, guys. Really appreciate it. I know it's getting a little late here, and I hope you enjoyed this presentation and got a lot from it. Again, reach out to our team if you have any questions. Appreciate you so much. Have a great day.